Hello and welcome to The Mortgage Conversation, a brand new podcast look and feel for SFI Not So Live. We're still the same people, still the same panel, still the same expert information that we always give, just with a brand new look and a brand new name. I'll be introducing the panel in just 1 second. Just a reminder that we are recording this at an earlier stage, so some of the rates and information that we discuss might be slightly out of date. So without further ado, let's introduce the panellists. I think we already know this guy. Tony, welcome. How are we?
Hi, everybody. I'm good, thank you.
Happy New Year.
Thank you very much.
And how was your Christmas?
It was wonderful, thank you.
Good. Little introduction, go on. It's a brand new year. There might be some new listeners.
If there are new listeners, it's still me. It's Tony Hall, Head of Business Development at Saffron for Intermediaries.
You don't need any more introduction than that, do you? And Phil, you're with us again. Welcome, Phil.
Happy New Year, everyone. Happy New Year, Jay. I'm Phil Lawford, the National Account Manager at Saffron for Intermediaries.
I think we know who Phil is. I think we know who Tony is. But someone we haven't seen for a little while, we've just been discussing this. It's nearly 2 years, well, a year and a half since we've had her on. And that's Steph Daly. Steph, welcome.
Hello. Thank you for having me. Happy New Year.
Happy New Year to you. And look, quick introduction to camera, because we always make our guests feel really uncomfortable to do that.
Yes, hello. I am Stephanie Daly, Director of Partnerships at Alexander Hall. I have been advising for the last 12 years. My job role now, I focus a lot on lender and proposition development and relationship building and seeing what our customers want coming into next year.
There we go. So it's 2025. It's time to look back a bit, I think. Let's do a bit of reflection first. In this podcast, we're going to do it in 2 phases. We're going to reflect on what happened in 2024, and then we're going to get the crystal balls out, as we like to do all the time, and predict or give a little bit of a prediction of what we think 2025 is going to be. So without further ado, Tony, let's come to you first. 2024, give me a summary analysis, not too much detail, because we're going to go and find a detail, but just your analysis.
Again, it's just one of those crazy years in the mortgage market. We don't seem to learn. We don't seem to like any sort of normality because it's always up and down. But actually, I think Phil's always said this market thrives on confidence and stability, and that's probably the one thing we don't ever have at the moment. Mm-hmm. But the confidence is returning to the market, and you can see that in the figures, which we'll talk about. So there's still a lot of bumps along the way, but what I have seen this year and previous years and beyond is this: we are so resilient as an industry. We can ride these bumps, and we'll just continue to do that because you have to in this market.
And there has been a lot of change. I mean, the last few years have been
new
hideous.
New government,
everything.
Global issues. It's just madness, but it's a good.
But the market's still up there, isn't it? It's still people are still looking.
The market has done more than it was predicted. Absolutely, yeah.
Steph, does that reflect what you've seen?
Yes, well, for me personally, it is my first year back at work as a new mother. So returned
congratulations.
In May this year. Thank you. So that's been a very interesting challenge, but fantastic to get back into the business and speaking to clients again and seeing what people want. But I truly think that 2024, I think it's been a really good year. I think it's obviously we've had a new government. We've had a lot of promises coming from them in terms of what they're wanting to do going forward, especially in the new build space. But I think just having had the new government, sort of, no matter people's political affiliations, but that will help provide stability over the next period of time. So especially in the lender space, we've had the budget now. You can just get on with making some plans. And I think that's desperately what the market needed, certainly over the past 2 years, where we haven't seen really any stability.
I couldn't agree more. Phil, hi. Hi. Your analysis, just a quick summary. We're going to go in detail in a sec, but does that reflect?
Yeah. I mean, clearly the general election was the biggie and the big topic that probably stalled the market slightly. Then we had a second stall waiting for the budget. But the year is looking to be better than what we expected it to be. We were looking at expecting a £225 billion lending market, and we think the market's going to be about £230 billion, and we are bullish for next year as well. So things are looking optimistic, and we're certainly in a better place, I think, than where we were this time last year.
Mm-hmm. Well, all three of you have mentioned the election and the new government. So let's just start on that. Just because our most successful podcast, I don't know if you know this or not, but most successful podcasts have been when we analysed what was going on in the election and we really watched what was happening and gave your experiences. How's that been after? I mean, it was a turbulent election. It is a brand new government. Labour's in. They've got a lot of promises. Steph, you just mentioned one. Are brokers, are lenders, are they feeling that sense of stability? Are they feeling that perhaps we know now we've got at least 4 or 5 years where we're going to have this government in, and we might not like what's happening, and things are a bit turbulent, and it's not been the best ride for them? Is that providing confidence? Are we seeing confidence within lenders, within buyers, and the consumer, I suppose, as well? The purchaser. I mean, is it changed for them?
Look, it's as confident as you can be in a floating platform, which changes quite rapidly. So, but the market swap rates are stable at the moment. The obviously the 2-year prediction is still unnaturally higher than the 5-year, because that's good, because the 5-year is saying actually we're going to see rates coming down, but it's going to come down probably more later than earlier.
Right.
If that makes sense.
Yeah.
That's why 2 years more expensive. But rates are going to be dropping. I think they're not going to hit any of the low levels that they were, but that's good for the market. This market, for us as lenders, this market chucks up some opportunities to look at lending, not with just fixed rates, but looking at how discounts and trackers and products that work really well in a reducing rate environment. But at the moment, we have this really odd paradox that fixed rates are cheaper than administered rates.
Right.
So whilst people could be saving money on an administered on a discounted rate, that the underlying rate is not cheap enough at the moment to make it viable, which is a challenge and an opportunity for us, really. So yeah, look, lenders we're kind of used to it, really. You just you got to set your sights. We'll come on to what next year I think is going to be about later on, but there's a different market dynamic coming, which we're seeing in lots of reports. So I'll let the others talk first, and we'll come back to that.
I have the same question to both of you two. So.
Yep. From what sort of my thoughts, obviously coming from the advisor background, but what I've seen from a lender's perspective is that now that we've had the budget, there was a lot of conversations in the run up to the election, like, will Help to Buy come back? Will there be any new help, like first-time buyer schemes, or anything to help getting first-time buyers back on the ladder? We've got the new government, we've had the budget, we know that we've got confirmation that the stamp duty changes from the 1st of April will continue to go ahead. There is no new Help to Buy scheme. And so what I've then seen is lenders are then keener to press ahead with their own innovation, certainly in the first-time buyer space. Whereas prior to the budget, I suppose it would always have been the case where, do we look to invest in this idea that we've got, which can help the first-time buyer market, when we don't know what the government's going to do? So I actually think from being able to advise on that, and of course it's been fantastic that we've had a lot more options come through from the lender space in terms of helping the first-time buyers and boosting affordability, which I'm sure we'll come on to, but that's been really good post-budget, which I imagine has come from the stability that sort of lenders are expecting to see. But from the consumer side of things, so conversations that we're having with buyers and sellers, there has been a lot of wait and see over the past sort of 2-3 years even. So of course, interest rates over the past 2 years have sort of peaked massively post 2020, end of 2022, early 2023. We saw rates starting with a 6, which is just sort of, when you're speaking to a client, that your interest rate is going to go from something starting with a 1 to something starting with a high 5 or even a 6. That's not a nice conversation to have. Now having conversations where it's starting with a 4. We had a period where we were able to say it started with a 3, which was lovely. Obviously post budget, we've seen that these swap rates did increase. So as of yesterday, where we are recording this in December, I didn't have any rates which were starting with a 3. But fingers crossed, when this goes live, we might have a few more. But the confidence from consumers we're definitely seeing, and we are also quite privileged in the fact that, as at Alexander Hall, we are linked with an estate agent. So we're linked with the biggest estate agent in London. So we are able to see the confidence coming through from their stats and their data as well.
That's a useful insight for you, I'm sure.
Absolutely.
Really useful insight.
Yeah. So, I mean, just on the confidence from their side of the market, for example, they have had their highest Q3 revenue in sales that they've had in the last 10 years, which is quite surprising given sort of what we've seen. Certainly if we'd have said that at the start of 2023, that by Q3 2024, you'd have had your highest revenue in the last decade. You wouldn't have believed it.
I agree with that one. That's good.
Thanks, Steph. Phil?
Yeah, there was a lot of different views on the budget, but I think what it has given us is some certainty with what we need. We know, as Steph says, we know what's going to happen and what's not going to happen, which gives everybody a platform to plan, and that's what business needs. That's what lenders need. I think that's what consumers need as well. There was a bit of turbulence with the swap rates in the market, but all it really means is that rates are still coming down, just perhaps a bit slower than perhaps we were hoping that they would. But things still are generally looking more optimistic. I think it also depends where you get your news from as well. If you follow GB News, then the world's going to end. But if you follow Channel 4 News, everything's fine. So I think you need to choose where you get your news from to get a different, you'll get a different perspective.
In my line of work, I can't make comment on that. But I have to agree. I think, again, if you look at the response from businesses compared to the business press, it's very different. Business leaders are talking very differently to what the business press are talking about. And so, it's difficult to weed through, and I think we have to be really careful.
You've got to sort of almost take the politics out and just look at the facts.
Exactly that.
Yeah.
Exactly that. And I think that's a lot of the problem. Consumers don't get access to a lot of the facts, and so therefore they're reliant on the news a bit too much. And
Which is natural, isn't it?
It's the way the world is, isn't it? I mean, look what happened in America just recently. People are now upset about the outcome, but they didn't listen to the facts in the first place, or didn't understand the facts in the first place. So, education, isn't it? I know we talk about that a lot. So let's talk about the overall market. Let's talk about. I'm going to touch on house prices a little bit because they went down for a period, but they've gone back up again. You might have a bit of insight than I do in this step.
We have the expert.
So let's talk about some house prices. What the end of the year? What did it mean for buyers?
And so, going into 2024, there were forecasts that house prices were going to drop. We've had house price rise marginally. But so I think depending where you get the data from, anywhere between sort of 2 to 2.5% increase over 2024. I think that just helps to give. We've said the word a lot. It does truly help to give confidence in terms of those people that are looking to upsize or get onto the property ladder. Mm-hmm. So we've been hearing about this property bubble bursting. We've been hearing about that for years, but we had a lot of press about that post-Brexit, during COVID, then of course changes to the sort of mini-budget 2022, house prices are going to crash, and that just isn't happening. So that really does help, I think, to give stability, to make people the ability to make longer-term plans. So sort of if I go back to some of the data from our sort of parent company, they have got the highest volume of under offer properties. I think it's about 30% up, as I said, year on year.
Wow.
In terms of under offer properties, which is absolutely fantastic to see and help people to make plans.
Yeah, I was speaking to somebody from Rightmove recently at a mortgage event, and they're telling me that new listings are up 11% based on this time last year.
Wow.
And they're now at 2019 levels, so they are at new listings are at pre-COVID levels. Mm-hmm. So I think that's something we probably don't think about, and so we should be optimistic about. And also consumer demand is now at pre-mini budget levels, back in 2022 as well. And that Rightmove are predicting 2025 2 to 4% increase in house prices, and rental incomes are also up. So that's probably due to higher swap rates and landlords reflecting that. And regionally, every region is also up as well. So the market is in a much better shape. And isn't
that reflective of a lot of demand? though, because we don't have a lot of housing.
Yeah.
You touched on the fact that the house
Supply and demand, very
house
much.
building scheme that's been pushed, and it's only this week, we're recording in December, so this week Angela Rayner's been out pushing and pushing and pushing it. She held her own quite well with Trevor Phillips on Sky last weekend, for instance, where she was defending what they're building the houses for. But but there is a lot of demand out there. We need more homes. It's as simple as that.
Definitely, and of course that's what the government has promised to deliver. But I'm sure we'll touch on that further. But I think where we've seen sort of the house price growth, and it's only been sort of low percentages, and expecting house price growth again going into 2025. What we've also seen some fairly solid wage growth over the past 12 months as well. And I was reading an article which could be quite controversial, because it's like, is this the most affordable time to buy a property?
Wow.
Where we
Yeah.
are, it's because we've had such like the parity with and the loan to income multiples. So of course, when you go out there, it was London-based mortgage advisor, you go out there and you're seeing 2-bed flats pricing at 650 grand. That's not affordable.
No.
However, comparing it to that house price hasn't necessarily changed too much over the past couple of years, but people's have increased. So from that side, slightly more affordable, and I think we are seeing a lot more lenders open the door for a lot higher loan to income multiples and make it more possible for people to get on that ladder.
I mean, I think that's where we need some support from our regulators.
Absolutely.
Because of that, I think that's holding it back. I think we all agreed that it's affordability and housing stock are the two big issues. So housing stock affects supply and demand, which keeps house prices as high as they are, and then affordability will stop people being able to borrow what they need. And very often, it can still be affordable, but the loan to income caps at 4.5 times. I can't remember what percentage. 75% of lenders' book has to be at within 4.5 times. It's not making sense now. I understand why it was probably done back post credit crunch, but that's more than a decade gone. I'm sure we'll make a whole load of different mistakes next time round. So
You might not know the answer to
Yeah.
this, but how does that compare to other countries?
I don't actually know.
Yeah. Don't know.
Just
to
a
be
question I
honest.
want to ask, just because
Yeah,
America's having a bit of a housing crisis at the moment
Yeah.
as well. It'd be quite interesting to see how we compare and
You
whether
see,
anyone else after the credit
In
crunch
America,
has
they have
sort of
longer
done-
term fixed rates, so
They do, yeah.
it doesn't. It
Yeah, it's not
matters
so
less
of an
probably
issue.
as well.
It's a one-off kind of thing.
We
Yeah.
we are quite
Because
unique.
we always talk about the
having
fact that
shorter
we're quite
term
an old
fixed
market,
rates.
We're quite
Yeah,
old
yeah.
in our ways, and we
Yeah.
haven't developed and matured and as we should have done, perhaps a bit
Well,
slowly.
we are starting to see more lenders come out, of course, with those longer term
Yes.
fixed rates.
We
10,
discussed
15
this not a couple of
10,
months ago, didn't
15
we?
years,
Yeah.
high loan to income multiples, but that's sort of it's absolutely fantastic for the right type of client. But you're looking at sort of borrowing 6.5 times income, you're pretty much tied with that lender for life.
Yeah.
Unless your
Yes.
income's going to be growing
Yeah.
significantly.
Or more lenders come into play.
Of
Yeah.
course.
So on that note, this is you just touched on it, Phil. It's a perfect chance to pick up on this. The two big issues, and one of them is affordability. We're in a cost of living crisis still. We can't deny we're not. Inflation really isn't settled, is it? It's going up again. It's fluctuating. It's not at the positive level we thought it might have been.
Yeah.
And it's certainly changed since the budget. So it is going to be harder and harder for affordability. What innovations have we seen in 2024? What have we seen people do? Have we seen any exciting things you think, oh, that was a really good idea, and that could bring us into a positive 2025 for people? And is there optimism when it comes to the cost of living crisis? Are we seeing some positives?
Well, from an affordability perspective, every lender is who has an appetite to lend wants to help people. But as Phil has mentioned, regulation is a sensible barrier, but also an unhelpful barrier in a lot of situations. So what you are seeing this year is more and more lenders are stretching their LTI limits. We've done it. We go to 5.5 times now on our professional income boost product, and we're looking at how that works, and we're looking at how we can do more with that. We've also tweaked personally, and a lot of lenders are starting to tweak their affordability calculations, so not just the LTI cap, but what expenditure are we putting into our affordability stress model. we've recently redone ours and removed some bits that probably aren't relevant in this market now that have always been there. So
Have you got examples of that? What sort of things?
it's just probably the cost of utility. It was put up, 2 years ago because the rising cost of heating and power. But that's not as expensive now. But models, ONS models and things like that hadn't necessarily changed to reflect that.
Of course.
So we've done that. Other lenders kind of got on that earlier. I know Leeds probably about a year to 18 months ago made a trick to people buying A to C rated property and said we won't put as much on your bills as if you're buying a D or lower property.
Okay.
Which was good. So lenders are doing their best. I noticed even like the Stafford building site yesterday announced a removal of their LTI limit on lending. I think there was some caveats, so don't rush off and go, I can have 25 times income. But everybody's looking at how can we help. But to Phil's point, I think we need to look at the market we're in from a regulatory lens and go, are we enabling or a blocker to what we're actually all trying to achieve, i.e. great outcomes?
Is there any grumblings from the regulator? Any sign that they're listening?
Not that I'm aware of, if I'm personally honest,
Yeah, agreed. I think you've got the affordability challenge, your loan to income cap. So we have seen quite a few lenders come out with the higher loan to incomes, which is absolutely fantastic, especially in the professional space. We've got some lenders who are doing it purely for first time buyers, but I also feel that if lenders who are only doing it for first time buyers, you're then missing out on the whole group of people, the home movers who need to exit those first time buyer properties to move on to the next one.
Chain needs to keep going, doesn't it?
Exactly.
You one bit of the chain stuck, then the whole cycle stops.
Exactly, which is I do think we need to do more for downsizers, and I feel it's a real shame that sort of government missed a trick in terms of like making some stamp duty changes for downsizers to help free up some property. I thought that could have been something they could have added in. You've got the affordability side, which we've discussed, but it's also your entry deposit levels, so your loan to values. So we have seen some really good changes this year in terms of higher loan to values being allowed, especially in the new build space. So where there is so much focus on new builds at the minute, I think it's been a really good opportunity for lenders to actually review new build policies and look at, okay, we can start to get comfortable with maybe a 5 or a 10% deposits, and which is what we've been crying out for. I know a lot of lenders have done it on houses for a long time, but certainly for flats, which is your first time buyer space, especially in the southeast, that's been really good to see.
Good stuff. Just said to focus on, I changed the swing a little bit. You said the focus there was on new builds, but we have a lot of property that's vacant, needs some work. And so, again, Phil, you can answer this one for me. There's been some innovation in products to get people to renovate properties and do things differently. And looking at these, I mean, we've had programs that have helped us to do this, and we'll come on to self and custom build in a minute. But I'm talking about renovations and actually, what's the best way to describe it? So homes under the hammer style. This house has been empty forever. Oh, I've got a vision. I want this. My sister's done it with a house. And is that? That's another innovation. You use the stock that's there.
Absolutely. There's a whole cohort of building societies, probably nearly 20 building societies that do self-build mortgages. And self-build isn't just to do a bit of build up from the ground up. A lot of those self-build mortgages can be used for renovations. So it is buying a property that's not readily mortgageable on the high street, can be used as a renovation. So if it's not got a working kitchen or bathroom, you're not going to get that mortgage with your standard lenders. But if you go to a mortgage broker who will place you with a building society like Saffron that can do self-build mortgages, then that's a great solution there. So you can lend against the value of it in current condition, and then also borrow in stage payments up to the end value. So that's a great way of getting that equity uplift as well. So you might be buying it a bit cheaper because it needs a lot of work, but you've got a big equity cushion there when you've completed it. So You're absolutely right, Jay.
We've also seen a lot of innovation come through this year in terms of retrofit and the green space, and I think we will see a lot more of that. So, where landlords have now been told that they need to be EPC C by 2030, there's a huge amount of property which obviously is not up to scratch across the whole of the UK, and I think that's a massive opportunity. So for the first time buyers, for example, says there are products where you can purchase property in its current state. You can help to get grants. You can get cash back from the lender, and then if you're proving that you are helping to improve the EPC rating of that property. And I think that's another massive area of sort of innovation that we have seen and that we'll continue to see.
It's nice to see that going, because the conversation about green and green issues in the run up to election kind of took a back seat slightly, didn't it? So it's nice to see that within the space, they're still carrying on and cracking on with that, and I've seen some growth, which is really good to see.
Definitely the right thing to do.
100%. Tony, your métier, self and custom build. We've talked about, I'm kind of reflecting on 2024, and I think we've talked about self and custom build more on this podcast than most other things, just because it's a space where we can see good growth. It fixes housing supply issues. So I'll let you have your say.
Oh, look, Phil's mentioned a lot of it in terms of how it can be. It's not just grand designs. I mean, that's what NAXPA, which is the trade association, which I'm on the executive board of. That's one of our key aims, is to demyth grand designs is the way to self-build a house. It is a way, but they only make that because it's interesting telly when it all goes wrong. That's not the plan. In fact, I don't believe any of those guys would get mortgage lending on the way they run their projects. And quite frankly, some do, because we do them. But a lot of them aren't run very well, but that's exciting telly. So self-build is, and particularly even more so custom build, which is self-build light, really. And
that was another grand design program, wasn't it? What do they call it?
They call it
the street.
The street.
Yeah. So that introduced
Graven
custom
Hill.
build in a slightly different way, didn't it?
Absolutely.
To just knock that on the head of it.
Custom build is certainly one way of regenerating our inner city brownfield sites, because there's a load of available space either in abandoned warehouses or whatever that could be repurposed into accommodation via a custom build route. It's not always about building lots of houses elsewhere and then having the infrastructure worry of schools and shops and roads. Actually, all that infrastructure exists in inner cities and urban developments, and we're not using it. So custom build can definitely help that. Self build is part of the solution to we're going to build 1.5 million houses, which is a challenging aim, which I think government are already realising is a bit of a challenging aim. But certainly self build, as Britain's fourth largest builder, can help that. And actually all the research shows that people are more comfortable with small development sites than they are with big builders building loads of properties near them. So actually, that's another key factor. So we do a lot of education with brokers. A lot of people are scared by it because of what they've seen or don't want to know. But actually, we do a lot of hand-holding in this area. And we've seen our share growing, and we're pushing for even more next year. We've got bigger targets to hit so it's more about people just don't be scared of it. Jump on board. 100%. Yeah, you've got people that actually could buy the house that they probably would want to buy in 10 years now. Yes, there's some effort. Yes, it does come with a bit more stress. Let's not lie.
Yeah.
But it's a viable opportunity, and the biggest enabler to it is planning reform, which is another big arm of NAXPA, is to lobby government and drive government to really push it forward. And we're seeing, encouragingly, positive signs from the new Ministry of Housing, willing to listen and engage, which is exciting.
It was part of the manifesto, so they've got to commit to it. So
but it's still massively understood as a subject. That's the problem, and it is. Look, in the context of the market that we're in, self build is very small. Yeah. In fact, no one actually knows how big it is. Funny enough, we're just supporting some research to actually size the market, and in line with a number of other entities to actually go, this is the size of the market. Then once you've got that, we can then see how we can, properly make it work. But it is a viable option for people who want to build their own home, who want to repurpose a home. don't discount it, and that's go and speak to your mortgage broker.
Yep.
Because you probably won't get that advice anywhere but a broker, if I'm honest. There's probably a couple of societies that might advise on it directly, but this is a professional product that needs professional advice.
And I think that's good advice for listeners, because we do pick up a lot of consumers on this podcast. So we do target to
Absolutely.
the market and the broker market, but actually we do get a lot of consumers on here. So go and find a good broker. Ask
Absolutely.
around. People will recommend a mortgage broker, which I
Yeah.
think is lovely. They'll
Yeah.
say, well, this is a great person. You need to go to them. They know what they're talking about. So ask around, chat about, see the groups. I've joined loads of Facebook groups. I think I told you.
Yes,
in our
you told me.
meeting last week, and I'm amazed by the responses from brokers to consumers offering them advice in a Facebook group, and then they're connecting, and then then you've got the outcomes on there as well. It's lovely to see. So yeah, that's the advice to anybody that is in the buying process or looking ahead at that. We've got to move on to our predictions for 2025, because as usual we're drifting on in time. But just before we do that, Tony, one other thing I want to bring up with you very quickly is development finance, because
Yes.
we have touched on it with brokers before, and it's
Yes.
going to be a big focus for you for next year. So let's
Absolutely.
just look back on 24 and just tell us how it went. It was an area you took on, wasn't it, in 24?
Yeah,
And something
I
that
picked
you
up
didn't know
development
about.
finance. I picked up the team in end of January, and really this year's have been a consolidation year and repurposing ourselves ready for next year. So it was run separately, not as part of Saffron for Intermediaries. I've combined the team, we're expanding the team, keeping all the knowledge and experience, but we're learning from that. And next year we'll be launching new propositions to support the market. We've teamed up with the trade bodies, which we'll announce soon, because it's a real big area for us. So
just so the brokers are aware, that is for
Yeah,
small
this-
developers, someone who's got a bit of an aspiration to start their own building company, do small
absolutely.
plots.
It's anybody who, our definition is if you're building a house for somebody else to live in or to rent from you, that's our development finance proposition.
Mm-hmm.
If you're building a house to live in for yourself, that's
That was the
self-build.
definition I wanted, because that's
Yeah.
that's something I learned. That was a really good way of
Build
describing
to
it.
sell,
last year.
dev, build to live.
Yeah.
That's one. But we're looking at a hybrid that allows a bit of both, which bit of a teaser there, but that's coming through because we're getting more inquiries, as you just said, of people buying multi-plot sites but wanting to live
Even one of them and build two
and
others for two other people. Yeah.
develop two others. So let's provide solutions that help do that. But we're also looking at the start and the end of the journey. So helping developers buy a house before the planning on a bridging loan. That's a big market. But also there is a challenge with selling new build houses at the moment, which I'm sure Steph would attest to. It is a challenging market for particularly developers building speculative housing. If you commission housing, it's a lot easier. But if it's spec, there's a lot of it about. So actually, sometimes at the end of deals, those developers need another year breathing space. So we've got our development exit bridge, which is, again, not just us. There's a lot of properties in lots of get my teeth in products in the market from a lot of the lenders that will do that. But it's an area that we're looking to dial up because we see that it's a requirement and a need, and we want to really help those people.
Love that. Right. Who's ready to get the crystal balls out then? So it's the 1st of January 2025. We're looking at a new year ahead of us. And I have to say, this is probably the most positive podcast we've done for a while, talking back on 2024. All of a sudden we've gone, well, it weren't as bad as we thought. I think that's a direct reflection of that.
Yeah.
We've come out at the end of it and gone, okay, we're not in as bad a state as we might have been.
Absolutely.
There is some positives out there. So let's look to 2025 now. What we're trying to say, Steph, you haven't spoken for a while. Let's start with you. What are you seeing for 2025?
2025. So there is a huge buy-to-let opportunity coming up in 2025. So I think got the numbers, buy-to-let maturities estimated at just shy of £70 billion worth of buy-to-let mortgage lending. Of course, the buy-to-let space in the budget and generally over the last couple of years has been hit very hard. Mm-hmm. It is becoming a lot more of a professional space. Lenders are coming into that space a lot better to support the professional landlord and even the smaller landlords, which have definitely needed that support. So I think that's going to be a big change coming into 2025. What I'd like to see in terms of sort of wish list on the year for 2025 is generally sort of tech improvements in the property market space and in the mortgage space. So as an advisor, we certainly have. We are an ageing population of advisors. I don't speak for myself when I mention that, but of course,
Average age is between 54 and 59.
That's pretty insane. Male,
Yeah.
yes.
Yeah.
We will discuss this in 2025, won't we?
Yeah.
Well, that's a conversation we're
Yeah.
going to have, actually.
Perfect.
Let's get some more women in. And young ladies, by all accounts, well, look at those age grades. Let's bring some fresh blood
we
in.
need that diversity
Yeah.
and mixture.
Absolutely.
I mean, without wanting to move on to another topic, I mean, a lot of our problems that, you know, I'm saddened to say that this year I've had too many conversations with middle-aged men about their behaviour being inappropriate to female members of our BDM team.
Absolutely.
Wow.
And
Yeah.
it needs
Wow.
to stop.
Just one last week.
So
Wow.
yeah, that's if the negative on this year, it's that it is
That's something we
yeah,
have got this plan
that-
to
that
address.
we
in the
need
future podcast.
to
I think we need to address
as an
that.
industry we need to embrace
Yeah.
Yeah.
and,
But I think
and
there's-
change.
that will
yeah.
come. That is a positive for next year.
Yeah.
Definitely, Phil.
The fact it's
Sorry,
in the eye. now,
I've-
the fact it's
I
positive.
have moved, but we'll move back.
That's a nice
Yeah.
little teaser for
Yeah.
a future
There we go,
podcast, that's for
yeah.
sure. Yeah, sorry, Steph, where were you at?
Yes, so yes, improvements definitely in the D&I space, which will definitely continue. What I'd also like to see just from lenders is a fairer proc fee to represent the work that we do, especially in terms of the product transfers. So product transfers and remortgage market next year is massive. So there's a lot more remortgage opportunity coming up next year than we have seen certainly over the past 3 years, I believe it is. And the amount of work and advice that goes in to speaking to clients about all of the whole holistic range of what their options are going to be, you then decide that the product transfer might be the right way to go. I think sort of brokers and advisors need to be more fairly remunerated on
agree.
that side of things.
That's what we did. What we did.
That's right, you did. And
There you go.
the advisor, we are very grateful for that. Thank
Good.
you.
It's a
That's nice to
no-brainer.
hear.
It's a no-brainer from our perspective.
Yeah. So I think there's a huge amount of opportunity next year. As we said, the numbers coming out sort of from the estate agency side, from Rightmove, confidence in the market is very strong, and we're in a really good position to be able to sort of take advantage of that. Buy-to-let market, absolutely massive focus, and sort of the refinance market and valuing advisors across all measures.
Phil?
Okay, yeah. So probably as I said at the start, rates I think will, unless there's any further unexpected world events that we can't
Well,
foresee
it's still
now.
we are still in a difficult period to even say that, aren't we?
Rates are still expected to come down gradually. So you know, I'd say 4 rate reductions, but probably will be about right based on what we know today.
Did you predict the one drop we did get at the end of this year?
I did. I predicted 2, but
okay.
then we had. Looks like there's only going to be the one.
The one.
I don't think there will be one in December now. No. But yeah, as Steph said, I think the buy-to-let market has just become more professionalised now. So it's not a place for amateur landlords anymore. But there's big opportunities out there still for professional landlords, and UK property is still good bang for your buck. It's a nice, safe home for capital appreciation, and I don't think that will change again due to supply and demand. So I think the buy-to-let market will continue to be resilient. And yeah, we'll have to see how these planning reform starts to bed in. Hopefully by the back end of next year, we'll start to see some tangibles and some benefits from that, hopefully, and we'll start to see spades going in the ground a bit more by the back end of next year. It's got to start happening.
Yeah.
So
There we go.
that's my
Phil's
2025.
predictions and wishes for
go.
2025. Come on then, Tony. You've got a little while. You're all right.
Yeah.
It could be a while.
Absolutely. So, well, look, firstly, the market size, I think it's funny because we're looking at this internally, and UK Finance at the start of the year were predicting a 2025 figure of 215 billion. And I think obviously this year is going to, the UK Finance have just published its 230 billion. Sorry, this year.
Last 25.
And then we're looking at potentially up to 260 next year. So we're seeing some positive growth in the market. But as I alluded to right at the start, there's going to be bumps. You've got the Renters Reform Bill.
Yeah.
That's and it feels the right point saying there's no market for amateur landlords, which I agree with, coming in. But 64% of the whole buy-to-let market is amateur landlords.
Is it as high as that?
Absolutely.
Oh, that surprised me.
So it's the portfolios that are growing, but there's still an awful lot of guys with one or two or 3 properties under the classification of portfolio. The rental reform bill is going to be a challenge for them. Mm-hmm. I think so, and I personally think we'll see that bill come in and then go through because it's a bit late for changes, and then bill version 2 quite quickly because I just think it's flawed from a personal perspective. Yeah. But buy-to-lets landlords of all shapes and sizes are proving their resilience. It's the only it's an odd one, isn't it? We've got a shortage of supply, yet we're doing everything to. Normally, in that environment, in a market, an established market, you have a stimulus to help the market. We've done the opposite. We've done everything to bash them on the head. We've made it more expensive, harder, and that continues with EPC ratings and all that. So it's a really odd one. I don't know why government doesn't like the buy-to-let sector, which is a real shame because it's a hugely important part of a healthy mortgage and housing market. So I think there's that. Next year, I think the UTB, United Trust Bank, actually launched a white paper yesterday, which is their research showed that 72% of brokers are going, actually specialist in complex lending is where we are heading. Mm-hmm. And I think that's the answer. The world's getting tougher. The high street doesn't, long may they not do that because it's very much our business model, but doesn't recognise people that earn more than one income generally. Yeah. They don't like it. Whereas people are having to get by. You've got your spectrum. You've got the uber rich that always have had multiple income sources, or not uber rich, but richer or savvy, and that's very much our market. That's who we're looking to help: affluent professionals with multiple income and/or complex property. So that's where we sit. But further down the list, and there's a whole breadth of lenders that support people that are having to have 2 or 3 jobs just to bloody live.
Yeah.
And therefore, as lenders, we need to recognise that and go, this is the new world. We shouldn't be pulling back, going, we're not lending to you. Yeah. We need to be doing more. We're actually good at that as a lender, and lots of others are, but brokers are starting to see that they need to diversify their own, I'm sure Steph can come back to this, business model, because more and more customers need the support of lenders and brokers that understand that specialism exists. And we're not just talking specialists in terms of bridging and second charge, which are huge markets and hugely supportive of what people are trying to go through, but just general people who just need help. And that's what we're doing as a lender, and that's what lots of other lenders are doing. I'm glad the research is showing this, that actually with 3/4 of brokers saying, yeah, we need to support this market, we see this as the opportunity. I think that's what next year is going to bring to a big degree.
Yeah, gone are sort of the days of you being able to speak to somebody, right, 4.5 times income, there you go, there's your agreement to principle, and it's done. So lots more complexities in terms of people's incomes, credit profiles, credit commitments. We have been through a period of very high cost of living, as we've sort of mentioned. So it's now, in terms of from a consumer's perspective, going to the bank and just expecting to be able to be offered the best deal just doesn't exist anymore. Which is why I think the advisor market is thriving, and I think we're looking to be close to 90% of all new mortgages is going to be intermediated, and that figure is
interesting
rising.
actually. Yesterday, I heard Martin Lewis on his social media talking about getting a mortgage broker and speaking to mortgage brokers. The education is finally out there in the consumer space, because we've always talked about this, where you
Absolutely.
don't ever see anybody as a young person being told immediately to go to a broker, because actually that's going to help you. If they go to their bank, they'll go to whatever they're recommended by their parents.
Yeah.
And the parents' market is very different to the market it is now.
Yeah.
I know some of the parents and the younger parents probably were reveling in low rates. Their children are never going to see those rates. We've discussed this. They're never going to go down to the 1%, are we? So it's time for education. I think I did hear some waves from the new government about financial education going into schools. If that's a thing, and that starts to become a thing, then I think that's a really great thing. But I think the overall advice we've always given is go to a broker, because it's just where you're going to find the products that are going to help you, especially if you're not, as you say, a run-of-the-mill easy target.
Yes, obviously, I 100% agree.
I
Yeah.
thought you might.
But I suppose the one thing that, and Phil and I always say this actually, so I'm going to drag Phil into this moan, right? just in case, safety in numbers. But the one thing I ask of brokers is, do have that honest conversation with your client. As a lender, we see so many cases that we have to decline because a lack of due diligence has been done on that applicant. Spend the time to review the profile and the bank statements and the behaviours. I love Phil's phrase for this. Make sure your client, at whatever stage they are, match fit for that mortgage.
Yeah.
Make sure that when the underwriter's looking at it, they go, oh, I can understand this story. They're not mind readers. And so often we see poorly packaged cases that actually the best advice for that client is, you're not ready for a mortgage. Don't come back in 6 months, clean this up, sort yourself out. Or actually, I can get you one, but it's going to be with the lenders at the other end that are going to charge you an absolute fortune. So you can get your outcome, but it's going to absolutely cane you. But in 6 months, you can probably get one at half this rate if you get match fit. And I think that's the plea I have, and especially in the specialist markets. That's the sensible advice that's needed.
One thing we haven't done for quite a while, and I think is a 2025 focus for us, is to bring an underwriter in. Let's have a chat about what they do, their process, the fact
absolutely.
they're not mind readers, what they're looking for, what they're looking at. And those, if you are a buyer or if you're a broker, it's going to help you in both ways, because a consumer will have no idea what an underwriter's job looks like. But actually hearing it from their mouths might be that education we need. So maybe that's something we can...
it's a funny piece, because so often my BDMs and the intermediate support teams will get a phone call going, I've got this set of accounts, how much will you lend them? Right?
Wow.
And I'm like, we'll help you by all means, but you're the broker. If your client heard this conversation, I'd be running for, if I was your client, I'd be running for the hills. What, you can't even understand my business? Why should you represent me? So again, we're actually looking at how do we educate. And one of our own, Lee, who's my national sales manager, has just run an education session for the team on self-employed. And we're going to weaponize that and push it out to our distribution saying, would you like this? Because we think it's going to help you. We've done it on self-build already, and we'll happily do that. But it is a bit of an eye-opener, the amount of calls just going, how much will you lend?
Yeah.
Which is a bit of a worry.
That is a worry. And I think sometimes, especially, sort of we're trying to get newer advisors into the market. I mean, obviously we are very well known for our training and sort of 3-week induction process and everything that we do to help support new advisors into the market. But I think there's a lot of companies that don't do that, and perhaps mortgage advisors who enter the market on a self-employed basis themselves, given a laptop and a phone, there you go. Like, that is, for me, that is sort of absolutely criminal that they're not a mortgage advisor just because they've had their CMAPs. They need to have experience. They need to
CMAP's
work
the
with
entry.
colleagues.
Yeah.
CMAP's day one. It's
The start.
After that, it's getting there. But actually, again, another plug for the Working in Mortgages website. The joint initiative between IMLO and Amy around helping grow our market, helping get new people in. Is if new advisors want a mentor, there are hundreds of people signed up on the mentee on the mentor.
You do it, don't you?
I do it.
Yeah.
Yeah, I do. Obviously, we had Bav on the podcast, the advisor that I'm mentoring, and that's such a great help because it's outside of your business. So you can have a safer conversation about, I don't really understand this. I might not be getting the support I need.
Yeah.
It's safe, it's secure, but it works. So I would really recommend going into Working in Mortgages is the website. It's a whole
Just do a
raft
good
there.
Google search and find it. Yeah, absolutely. We'll get Imra and Amy in soon as well. It's been
Yes,
a while, hasn't
we
it?
must do. Yes.
I think if I was to reflect, I can't talk about the market because I'm not an expert, but I can about this podcast. I think this year for me has been the most education I've had with the guests we've had, the deviations we've had into other areas such as protection, where I learnt so much in the space of an hour that I hadn't learned in working with Tony for 6 years.
4.5.
4.5,
I know it
5
seems
years?
longer, mate.
It
but-
does seem longer.
Yeah.
Oh no, you weren't around for the first part, were you? You arrived during my tenure. But no, I think 2024 was our best year. It certainly was the best year for audiences. So thanks to all of you that joined us, because we have really seen a growth, and
Yes, thank you.
we really appreciate I mentioned earlier about the election podcast, but I really appreciate the audience growth in that, because they literally saw us as a point to come to understand what was happening during the election and how it would affect the market. And that's where we should take great pride. So you guys, a pat on the back for you guys, because you give all the information. And all our guests, and Steph, today you have been fabulous, as always.
Thank you for having me.
And we'll have you back in
Absolutely.
later part of 2025. If you hadn't realised, we are recording in December, because we've slipped up several times. But
if you haven't worked that one out,
we are
then
recording in December, because we're
yeah.
not sitting here on New Year's Eve recording for New Year's Day,
No,
sadly.
I would not be looking like this.
So no, Tony wouldn't be in this state and would not be here if this was New Year's Day. So, but just a big thank you to all of you who have watched and listened this year, because I think we've been really proud of what's happened, and the new changes for 2025. I hope will prove the credentials the guys here have, and the amazing guests we've had throughout 2024. And I look forward to more in 2025.
Absolutely.
Look out for our new socials. Give Saffron for Intermediaries a follow on LinkedIn, where you can find all the updates for these. Don't forget to give us a follow on your favourite channel. So that's Apple Podcasts. Spotify is where you can see this video version, so it's much more interesting to watch. But if you're in the car, you can't watch. So Apple Podcasts is a good one. Sign up for the thing. And if you can give us a 5-star review, it helps other people to find us. So that'd be really useful. But for now, for the first one of 2025, thanks, Phil. Thanks, Tony.
Thank you.
And
Thanks, Jay.
thank you to our special guest, Steph.
Okay,
Well,
thanks
nice
to
to have you
Steph.
back, Steph. It's been a little while, hasn't it?
Thank you. Great to be
We
back.
won't leave you as long this time. You're not planning to have another baby this year, are you?
No more
Okay.
babies
So
for
we-
now.
Congratulations, though. We're really pleased for you. And we'll see you all on the 1st of February. But for now, that's it from us, and we'll see you soon.
See everybody.
Thank you.
Thank you.